there's a lot of reports on the job numbers being good, but I wanted to outline a few areas of concern that I think are relevant. Right now, the trade issue, if you look at the farm economy, 40% of the farm economy is being supported by these subsidies that were put into place to counter the effect of the trade, if you will, the trade barriers that were placed up. Number one. Number two, there's a report from the National League of Cities where two-thirds, this is stunning, two-thirds of the chief financial officers of American cities with more than 10,000 people, so that includes small towns, predict a slowdown or recession in 2020. And I think thirdly, while the jobs numbers are good, Ty, we see a little bit of a lessening of the pace that we've had for the better part of the last decade. So those are areas of concern. And I think what's smart is we need to be thinking about the future and thinking about whether these are signs of at least a slowing economy, continued growth is down, and whether, I think, the impact of trade, the impact of the trade tax, trade barriers has not yet been fully felt.
Let's go to Ron. The Buffalo Bills are doing well, too.
That's they are 5-2, and they're playing Washington this weekend.
They're playing my team, the Redskins, this week, and we're hoping for the Redskins, or at least I am. I know you're not. Talk to what Mayor Morial just described here, because I think it does reflect a bit of a consensus, growing but slowing in the economy, certainly slowing in the manufacturing sector, probably largely trade-related, but also part of a global slowdown.
Yeah.
What is the potential deleterious impact on the stock market?
Well, I think, if it were not for the trade war, the tariffs, import taxes, whatever you want to call them, this economy would be firing on all cylinders. I think I'm upgrading my outlook a bit for next year from growth recession to soft landing. I mean, the Fed's done what it's needed to do. Labor market's holding in reasonably well. If they
revised upward on
a lot of the numbers, yeah. I mean, not the way the president described it this morning, but you have to say that if there is some resolution of the trade war and that pressure begins to lift, then maybe the growth recession below 1.5% is off the table, and maybe you're 1.5 to 2. It doesn't mean that it's all roses. You can't get to 3% from here. Very difficult to do that, but it's maybe a little better. And the bond markets around the world are telling us that as well. Maybe it's a little better than we thought.
Slow growth, I mean, I feel like there could be a case to be made that this is sort of a Goldilocks environment for stocks, because we're seeing some growth, albeit slow. The Fed has made clear it's going to take a lot for them to raise rates. So if rates remain low for this long and we have slowing growth, and then we have the potential upside of any sort of trade breakthrough, I mean, that's not bad.
Right. And I think, it doesn't really, from my perspective, it doesn't change much with respect to an investment outlook. You're still buying quality. You're still buying those names that will do well in any environment, and they will continue to do well. When you talk about Apple, Disney, McDonald's, Starbucks, whatever, group of companies you want to discuss, they're all doing fine. They're all, in many cases, hitting new highs. And a little increase off the bottom in growth would be a net benefit. And if the dollar should weaken a little bit, if we see some trade-related movement there, that could be a large plus for multinational companies. And
I think you could get maybe small trade movement, but I think a large breakthrough won't happen until after the election. I think the Chinese are going to keep their powder dry, and they're going to make a determination based on the long term. My major concern is whether the Chinese, seeing this environment, are going to develop other long-term sources, other long-term places where they can buy agricultural products. Those agricultural products, which are critical to the trade relationship between the United States and China, drive our transportation and logistics sector, our ports, our agricultural sector. So there are a lot of things to be, I think, concerned about in the face of where we are now. And I think we need to be thinking about that.
But the one thing I don't think you can say that the job market is not in a good place.
The job market has been consistently good for better than a decade. The growth has been tremendous. And as we've talked about before, the challenges I see with in the communities that we work in have more to do with stagnant wages, the depressed housing market, the increase in rents and mortgages, underlying economic structural issues that have to be addressed. But the jobs market has been consistently good for
We've got about a minute left, and you and I were talking before, and yesterday, I guess it was, Elizabeth Warren came out with her plan to pay for what she calls Medicare for all. It would be my word, not hers, radical change in the way Americans are insured and pay for their insurance. What do you think? $20 trillion over a decade. $20 trillion, I think, is the size of the annual GDP in this country.
Responded to her critics who said, put not only your plan on the table, but how you're going to pay for it. Here's my concern. The needs of the country are in healthcare, but they're in education, they're in infrastructure, they're in housing. So if we're going to do any sort of revenue enhancement, the debate is where and how should the money be allocated? I see a need.
And this would allocate almost all of it.
And the question is, and the debate is, can you improve the system without such a radical change?
So let me turn to you. You know what Lee Cooperman has said about Elizabeth Warren.
Yeah.
That if she becomes president, the market goes down 25%.
Right. So most long-term investors, including Lee, have always suggested if the market goes down 25%, you find more opportunity to buy good stocks that you like. So if he was going to say down 50, 70, 80%, I think it would be a more consistent argument about the threat to a market-based economy. Having said that, I mean, it does seem that if a progressive became president and they ran the table in Congress, raised taxes by $20 trillion over a period of time, I didn't see anything in Senator Warren's proposal that would deal with the million-plus people who would be unemployed if you shut down the private insurance industry. That's something that would have to be rectified as well. So, anything that's that earth-shaking as far as the composition of the economy is concerned is going to be problematic. If somebody's going to tell me that the market's going to go down 25% and rebound, do I really care? When we're trained to say that a 25% pullback is relatively normal in the overall scheme of things, and it just represents a buying opportunity. If you're talking about a secular bear market and some sort of real disruption in the economy, that's a different conversation to be had. And you could make that argument, but just looking at it in stock market terms doesn't make a lot of sense.
We have to leave it there.